Hey, what's going on, best ever listeners? This is John Casman here hosting Multifamily Mastery, and I'm super excited to bring a guest that I've had the pleasure of interviewing on my own show, Multifamily Insights. So to bring him over here on the best ever platform, it's a great pleasure for me. Let's welcome to the show, Axel Ragnarsson. Axel, how are you today, man?
I'm doing well, John. Appreciate it.
Yeah, Axel, listen, you and I kind of go back. We've done a few interviews together in the past. I know a lot has changed. For our listeners who are not familiar with you and your story, take a minute and give us a little bit of your background.
Absolutely. So high level, live in Boston, Massachusetts, from New England, grew up in New Hampshire, about an hour north of Boston. Started buying real estate back in 2016. And the very quick and dirty on how I got into the real estate business was, it's a bit of a unique story, I guess. Was buying and selling cars throughout college. It's like, the way that, as the way that I was making money at the time. Was coming up on graduation and trying to figure out what came next. And I thought, hey, flipping cars, flipping houses. Yeah, they're pretty similar, right? Same fundamentals. So basically I got into real estate through the lens of I was trying to buy and sell houses. And as I was learning about flipping houses, learned about rental real estate and multifamily real estate, cash flow, passive income, all that stuff that I'm sure many of the listeners kind of, learned about at one specific point in time. And from that point on, started trying to figure out how to buy small multifamily properties at the time. And for the first 4 or 5 years of the business, really 2016 to 2020, built a portfolio of small multifamily properties just with my own capital, own resources. Was really good at finding direct to seller deals, putting them together with seller financing, private money, alternative financing of some kinds, and then refinancing into bank debt and holding on to them. 2020 rolls around and kind of have a come to Jesus moment of, hey, is this what you want to do forever in real estate and just try to spread your own money over a bunch of these deals? And felt a little risky at the time to continue trying to grow the portfolio with just my own resources. So started to figure out how to partner with other folks and raise capital. Now, last 5 years has really been, I'm still doing a few deals myself, but have very much been embracing the model of let's raise some retail LP capital, syndicate our deals, or just joint venture with large capital folks on deals. And that's allowed us to pour a little bit more gas in the fire. So first 5 were basically, let's just do it myself. Last 5 have been a season of let's go and raise money and actually build a real business around what we do. And now what our business looks like is, similar in the sense that we do a lot of direct to seller deals. It's a real core component of how we find deals. Predominantly we're doing 10 to 50 unit, kind of small to mid-sized multifamily deals, BC class throughout the New England area, but like 90% of what we do being in New Hampshire. So an hour north of Boston for those that aren't familiar with the Northeast. And we'll buy a few hundred units a year, raise $10, $15 million a year to buy those units. And that's really become what our business is today.
Yeah, Axel, I love it, man. You talked about starting off as not really in the dealership world when you talk about buying and selling cars, but you were buying your own cars. I'm guessing off eBay or something like that, right? Just buying these cars.
Craigslist was the bread and butter.
Yeah. You're buying these cars, flipping them. That got you into houses and doing the same thing, ultimately transitioning more into rentals and then building up kind of the multifamily portfolio from there. You talked about being direct to seller, and that was a really important part of how you were getting started. Using your own capital, maybe doing some, creative financing deal structures, but it's still an important aspect of how you go to market today. Let's talk a little bit more about that. So what does direct to seller look like to you?
Yeah. And, I'll set the stage here a little bit in that I think it really works for us, especially because we're operating in a slightly more tertiary market. We are buying small to mid-sized properties that are owned by predominantly unsophisticated investors. And we haven't necessarily dealt with a level of competition that has reduced the effectiveness of what we do from a direct to seller standpoint. I say that because it's the inverse of, let's say, the person who's buying Class A assets in Dallas, where you're competing with an entirely different set of investors and they're owned by an entirely different set of, sellers, or I should say investors that own them who are going to ultimately sell them. So in our business, we very quickly realized that, sure, we'll pursue broker deals, but we're in a smaller market. And if we do that, we're just not going to do that many deals every year, and it's going to constrain our growth. So at the time, this is back 2016, I was very focused on, let's just get a list. Let's cold email, cold call these sellers, and let's just ask them if they want to sell. And that has basically evolved over the years to a little bit more of a sophisticated approach. But the fundamentals have remained the same, right? We have our dream list of properties that we want to buy, the specific cities and counties that we want to buy in, the unit range, and then we filter it down based on some ownership level data. How long have they owned it? What's the type of owner, whether it's an LLC, a trust, or an individual. And we basically built out a list from a most fundamental standpoint of these are the properties we want to buy in our market. And we just want those owners to know who we are. And from there, we then just back into how do we get in front of them, right? So it's a lot of calling, it's a lot of texting, it's a lot of emailing. Texting coming after we've contacted these owners. We're not going to mass SMS because there's rules against that and laws against that from a compliance standpoint. But, when we get in touch with someone, we've got their cell phone number. We're going to stay in touch with them over text over a long period of time. And then in the background, while we're prospecting to owners, we're just going to send some mail every 3-4 months, depending on the list. And our objective with doing this is not to get a deal. Obviously, that is fundamentally our end game objective. But I think in the short term, it's important from a mindset standpoint to understand that we're not reaching out to these people to immediately buy their property. We're just reaching out to them to build a relationship, to introduce ourselves, try to provide some value if we possibly can. And that actually changes a lot of the messaging as to how we reach out to these folks. Hey, we'd like to make you an offer in the place, but understand if you're not interested in selling, we'd love to meet another investor in the market that's doing something similar to what we're doing. Maybe we can provide some value to you. And if not, totally fine. Let's just stay in touch and would love to continue networking with folks who are buying the same types of properties that we are. And over time, this low pressure approach starts to help us build mind share and become top of mind with all of the folks in our market so that when they do ultimately decide to sell, maybe we're one of those calls they make before they go out and reach out to the broker or sell it to somebody else that maybe has been reaching out to them.
Axel, can I jump in real quick? Because you said a lot of I don't know if everyone's following, man, but you're dropping a bunch of little gems that
I kind of just ran for it there.
The barriers that stop most people from being successful. So I want to pause to unpack some of it, right? The first thing is the market. Okay. The reason you're successful, or one of the reasons you're successful versus other folks who may have tried this in bigger cities, well, you're talking about understanding the psyche of the individual you're reaching out to, right? So first of all, you're in more of a tertiary market. You're dealing with more of an unsophisticated owner, right? That doesn't mean that they're not smart. It just means that they're not necessarily trying to squeeze out every penny of profitability of their property, right? They're typically long-term owners. They've had it for a while. They're making good money. It's paid off, whatever it is. They're not sitting there every day calculating, what the current rent should be or how to recapture a lost lease and all that. They're just, it's making money. I'm cool. So it's an unsophisticated owner from that standpoint. And you talked about really a lack of competition in the marketplace, because these are factors that I don't think people pay attention to when they go and they try to start a direct to owner campaign, or they say, hey, I want to get off market deals. Well, listen, if everybody else is looking at these deals as well, and everyone else is reaching out to these owners, you're not going to be able to craft that great deal, right? Because they've got a lot of options. But if no one has ever reached out to them about buying this property and you're the only one that does, or you're one of a handful of people, now you have a little bit more leverage. So that's the first thing, is just who are you talking to and what is the audience that they have reaching out to them? So that was one. Then you talked about your goal is really to get to know them, to let them know who you are in the marketplace, to build a relationship. And you mentioned, you kind of segment your list based on how long they've had the property, the type of ownership. Is it in a trust? Is it an LLC? Is it in a personal name? You have other things that you figured out over the years, but ultimately you're trying to reach out to them and introduce yourself via phone call, via emails. Once you've done that, you can move over to SMS, but you're trying to really build a relationship first. And again, I think so many people just go straight for the sale. Hey, here's an offer for your property, or, do you want to sell your property? And that's really off-putting. And at the end of the day, we talk about this being a relationship business, but then we get to, a tactic like this and people seem to forget the relationship part completely. And they go straight to the numbers or straight to an offer without building that relationship. So I just thought that was really important and heavy. So I wanted to just kind of jump in real quick there, because it may feel like a nuance, but it's not. It's the difference in being able to stand out, because you're not just saying, I can buy your property for 70 cents on the dollar. Do you want to sell? You're actually taking the time to get to know these individuals. And that's very different approach than what I hear from about 80% of the people in the space.
Yeah. And I'll expand on that too a little bit, and I think when people hear direct to seller marketing prospecting in the real estate business kind of at large, maybe if you're a multifamily investor, you're at a meetup, you hear somebody talking about how they do direct to seller. Your first mind goes to how a lot of these single family flippers, wholesalers, et cetera, do it with big yellow postcards, sell house fast for cash. And you're like, well, how did that, that's not going to work for the types of properties I'm buying because the people that own them aren't going to respond to that type of marketing, which is the correct assumption to make typically.
Straight in trash.
Exactly. Yeah. Right. And for example, like
if you even get to me.
Yeah, 100%. Right. And, as a multifamily owner, I get a ton of those postcards, right, from people that are just kind of rifling out marketing. And I throw them away, as you're saying. But the ones that I do keep, right, even as someone who, like, if I'm going to sell a property, I'm going to hire a broker. I'm going to work through a full process, right? It's kind of, we have investors in our deals. We owe it to them to go out and absolutely saturate the marketplace with our deal, et cetera. But I still save the letters of the guys who send me the letters and I'm like, oh, it looks like a pretty good letter. Seems like they're doing some business. I'm going to reach out to them because I want to learn more about what they're just doing, right? It's another person in my market who's buying deals. So even though maybe I'm not going to sell a property to them, I still want to network with them. And I still have productive conversations with a lot of these folks where it's like, hey, I'm also looking to buy. If you find something that doesn't work for me, maybe shoot it over to me. I'd be happy to pay a referral fee, an assignment fee. And I've found deals that way, right? So I engage with a lot of those letters, even though I'm not necessarily going to be the guy selling in my building. And then when I go back to the other side, when we're sending the mail, we're sending it to plenty of owners who are, when you think about what is the seller prototype of somebody that is willing and is actually looking to sell a property off market, right? It's probably someone who's getting close to retirement age, probably someone who's on the building for a while, probably somebody who is self-managing or is very involved in the management of the property, right? And they have relationships with the residents that are there. It's probably someone who is really relationship oriented in the sense that they just want to work with someone they like and who they trust, and they want to know the buyer, which is a hard feeling to have when you bring a broker into a deal because you don't have that familiarity. You're reliant upon the broker. And frankly, a lot of guys that we buy from or gals, whoever, are just people that don't want to pay a broker. There's still such a large segment, especially, and now I'm generalizing a little bit, but I'll just say the older segment of the investor base here, 65 plus people that have owned for a long time and probably came up at a time from a real estate investing standpoint where brokers were a little less prevalent than they are now. And more deals were done direct to seller than are now. But they just, you're like, I don't want to pay 4 or 5% to a broker. I'd rather just sell it to you and we'll take that off. And so, can't tell you how many deals we do with sellers that are like that, right? And it's really easy to define who those are and then to just try to reach out to them. And I think that the big thing is, and this ties back into the point that you were kind of highlighting a second ago, which is we're just trying to build a relationship with them. You're never going to convince someone to sell if you're out there doing direct to seller marketing and prospecting. Like, you don't get on the phone and convince the guy to sell. That's never really how it goes. You build trust over a long period of time, build rapport over a long period of time. And then when that triggering event in their own world hits them to where the partner wants to sell or they want to retire, they've just found out that the kids want nothing to do with it, or they're going through, 3 evictions on a 20-unit property and they just don't want to deal with it anymore. That's when they're going to call you because you've been top of mind and they're like, hey, I know that last year I wasn't ready, but now I am. And let's actually talk about a number. And all we're trying to do in the whole direct to seller world is to just be that first call and to just stay top of mind, which reduces a lot of the pressure around actually going out there and doing all of this. You're basically just networking at scale when you think about it that way.
Axel, that's a masterclass, right? In how to go direct to seller. And what you're talking about is really building relationships. And it's the thing that people, they want to skip over, but it's the truth, right? We do business with people we like. And you have to build that relationship. And it doesn't have to mean you're taking them to dinner every month or something like that, but you do want to be top of mind. So when they are ready, you come to mind. And there are people who, like you said, do not want to go through a broker, whether it be because of the commission or they want to be more involved with the person. Maybe they really have a deep sentiment with the tenant base. I remember we were buying a 95 unit property. And then one of the things was we got this property direct to the seller and they did not want the residents to know that they were selling. They didn't want anyone in the city. It was a small little tertiary market outside of Southern Ohio. And they didn't want anyone in the city to know because they're very prominent and they were really they were really adamant that we couldn't tell anybody that they were selling until this thing was done. And there are people who are like that. And you just have to recognize that everyone's a little bit different. Their motivations are a little bit different. And to your point, yeah, people tend to get burned out after 15, 20, 25 years of owning and managing a property. Sometimes, you do want to cash out and just say, you know what, it's trying to do something else. And I think we're in that stage right now where there is that great wealth transfer that's taking place. And people are realizing that, oh man, I bought this property as a generational wealth asset. My kids don't want it. They've seen me maybe manage this thing for the last 25 years and say, nope, I don't want any of those headaches. Yeah. And now they're trying to figure out what to do. And maybe they haven't completely decided to sell, but if they can find somebody who they could trust to buy that property, take it over, handle it with care, they may be open to it. So this is a strategy that, I know in my markets hasn't worked as well, or at least I don't know as many people who have used it with much success over the past few years. Mainly because it's just been so competitive, right? And these are larger cities that I'm in. But I do think now you're starting to see more and more people who are open to this just because the multifamily landscape has shifted a little bit. And the owners themselves, they're not getting bombarded every day like they used to. I mean, I was getting postcards, every week for sure on properties. I'm not seeing quite as many. And I think that goes to show that, hey, the sentiments has shifted. People recognize the economy is different. People recognize interest rates are higher. You may not get the number that you thought you could have got 3 years ago. So today, I think those owners are being a little bit more realistic. Can you talk to me about how you've scaled, right? Because one of the things we want to get into a show is it's really about your journey, and everyone's at a different place. And you're at a place now where you're scaling this portfolio. You're vertically integrated. You've got your own property management arm that's handling this. You're also doing the outreach and the marketing. So you're literally soup to nuts here. You're reaching out to find the deals on the acquisition side. You're analyzing them. You're buying them. You're doing the asset management. You're doing the property management. Talk to me about the scale and how you manage all those different functions.
Yeah, I mean, it's a great question, and there's probably a number of different ways that I could kind of go with that. I think number one, big fan of what is your constraint today right now in your business that's actually truly bottlenecking you. For a lot of people, that's deals in the real estate business specifically, right? For me, that was never really deals because we were really good at the direct to seller thing. For me, when it was the first 5 and I'm just doing it with my own resources, my own cash, it was capital, right? It was my own capital. And while I was buying great deals and pulling all my money out in 6, 9, 12 months, depending on the size of the deal and how long it took to implement the business plan, it was still the constraint in that I couldn't pursue more deals because I didn't have the money for earnest money deposits. And it was tying up money over here and tying up money over there, waiting on a sale, waiting on a refi. So the initial constraint for me became capital, even though we were still, I was buying great deals. There's still only so much you can do with your own capital. So for me, it was I need to just tie up smaller amounts and co-invest in these deals. And yeah, we'll still buy great deals and pull the money out, et cetera. And we'll make our investors really happy, but it allows us to at least build a portfolio faster, which was going to serve the second objective, which is actually bringing a lot of our management in-house, right? But I'll get to that in a second. So for me, it was just capital. I was in my mid-20s when we started raising money. I didn't have, family in real estate. I didn't have friends who were making enough money to really invest. So I was I got to go out and find people who have the money that are interested in being LPs. So for me, that was, let's just start posting on social media and trying to attract people to what we're doing in our business. That included starting a podcast and included starting, an email newsletter, going on other people's podcasts, like the conversation we're having right now. And then doing some in-person networking, but basically all funneling back to what is my objective? It's to get people who may be interested in investing what we do on our email list so that I can market to them. And when we have a deal, we can launch it to them. First couple of years, total grind, right? And this is even in the 2021 when money was flying around days. I was still struggling because I didn't have the network yet to really raise money from. Last few, that started to become a little bit easier because we've had multiple investments by some of our core investors, or early investors, I should say, who are now, the referral machine is starting to pick up. We've done well for them. They're telling their family members and friends about what we're doing, and then the social platform has grown, the Instagram, the podcast listener base, the email list. So now that's starting to become a little bit more of a flywheel, but that was really step one. And then I'll briefly touch on step two, which is really the people to help kind of manage all of this. And I'll break that into two buckets, which is call it the investments business, where we're going out there raising money and doing the marketing at the sponsor level, finding the deals, doing the investor relations, all that. And then at the property management level, which is obviously the much more personnel intensive segment of the business. The one decision I look back at making that was really, really wise, at least, I look back and thank myself for doing this, even though I didn't even really understand why I was doing it at the time, other than I didn't have the time to start the management company, was the third party manager we were working with, young guy working there. His name is Ryan, who was doing leasing for 400 units there. He was overworked, just going crazy. And I was one of their larger clients. And we basically had a conversation where he's like, I'm going to be leaving this business at some point here. I'm going to start my own PM. Do you want to come and work with me? And we basically were having a conversation around how we might be able to collaborate on a PM company together. And basically what ended up happening is we struck a partnership, me, him, and we had a third partner at the time who's now a smaller part of the business, where I was like, hey, you're going to run the day-to-day, take a salary, take this chunk of equity. I'm going to bring my properties as kind of the seed units to our management company, go and win third-party contracts. I'll get some preferential pricing as like the partner and the founding partner and being one of the larger clients of the management company. And that solves my management infrastructure. Now I'm an owner, I'm involved in the management company, but he's running the day-to-day. So luckily that was a structure that really, really worked well and was a win-win. And that doesn't pull me too deep into the management, and I can stay at the asset management level. And then while we did that, over on the other side, whole lot of virtual folks to help with asset management from a data analyzation standpoint. Just kind of doing a lot of the core asset management stuff, making sure that we're priced correctly, making sure that, we're not double billed on our owner statements for different charges or something like that, making sure that if a property sat vacant for a long time, we're adjusting the price or whatever. Basically everything that can be done remotely. I'm still the in-person asset manager driving around New Hampshire looking at all this stuff. And then a lot of folks to help with, acquisitions on the underwriting side, on kind of the data integrity side, on our lists. Folks to help with the podcast and creating social content and email content. And at some point here, probably in the short term, next 6 months, I want to make, a larger in-person, greater Boston area, New Hampshire area, to really start to take a lot of the asset management off my plate and like drive the properties on a weekly basis, so I can reallocate a lot more of my energy to finding deals and investor relations. Other big hire that we made that I can't forget is in-person acquisitions manager who's calling and actually going on the appointments. That was like a real big hire, and that it allowed me to scale the marketing, the list size, everything that we were doing without being the guy picking up the phone 15 times a day with sellers. And now I've started to become my own little, I'm basically the department head on the acquisition side and the asset management side and on the finance side. But ideally, we're going to be removing, asset management from my plate a little bit more and starting to continue delegating. But short answer to your question, it was capital. We got to figure out how to get money in the door to buy all this stuff. And so that I can keep pouring gas on the acquisitions fire. And then it's people. How do we actually solve all of the different workload problems we have here and solve my issue of being just too spread too thin? And that's kind of the phase of the business growth that we're in right now.
Axel, there's the thing about multifamily investing is usually this business really comes down to just deals and capital, right? Like everything else is certainly important, but it comes down to deals and capital. And most of the people who are not where they want to be, that bottleneck is on one of those two sides, right? It's either deals or capital. Everything else you can kind of work through when there's money flowing. But if you don't have the deals, it's hard to, do anything else. If you don't have the capital, it's hard to do those deals. But if you have those two, now you're getting into operational things, people, and, there are ways of solving that. I want to come back to there because for you, that bottleneck was capital. You had limited capital. You had your capital kind of spread across different deals. So you had to get comfortable raising capital. And I know that's something that's a challenge for a lot of people. A lot of people grow up with the mindset that you should be doing this by yourself. You build up your own portfolio, you save your money by a deal. That's exactly how I started as well. But there's a breaking point for most of us where you realize you could grow faster, you could do more, you could have a bigger impact, but you have to be accepting of working with other people and their capital and taking on that responsibility. You were able to do that You mentioned not having friends and family who had money to invest. So you really had to build this kind of public persona, getting on podcasts and email marketing and social media and all these different things to attract capital. And eventually it did work for you and you were able to start to grow and scale and then pair that with the deal flow you already had. What was the biggest challenge for you when you reflect back getting started with some of those activities to raise capital? Like, what was the biggest challenge or the biggest hurdle you had to overcome?
That's a good question. I think there was two, and they're more like mindset related for me at the time versus like tactically I was having an issue executing this, this strategy or this thing, right? For me, it was all mental. One, the reason I got into real estate and the reason I was selling, flipping cars back in college, and the reason I was flipping Xboxes and sporting equipment before that was like, I'm a very unemployable person. I've never had a job. I have no desire to work for somebody else. I have no desire to answer to somebody else. The biggest challenge with me with partnering with other people, whether it's just me and one guy buying a deal or me and 20 LPs in a deal, was I didn't want to answer to anybody else. Right. And that was a big challenge that I had with raising money. I knew that I could have grown faster raising money, and I knew that I was good enough at finding the deals and executing the deals and all of that to go out and raise the money and deliver great returns to the investors that would invest in those deals. But for me, I was like, I just don't want to have anybody else breathing down my neck, and eventually you just hit a point where you're like, okay, well, it's either that or you grow at this very slow pace and you're stressed out because you've got 6 deals going on with your own money. And you're going to sleep with one eye open on the pillow on many nights, right? It's like, okay, that's the lesser of these two evils in my mind is let's go out there and raise some money, right? That said, how do we raise the money in such a way that I'm not in a situation where I am truly answering to somebody else? And there's a couple ways here, right? When you're raising money, it's, I don't want to broadly generalize here, but like you can work with a large capital partner who, let's say you need $2 million for a deal and they bring 1.8 and you bring the 200 grand. If they're going to be that one big investor, they're probably going to want some control provisions. They're probably going to want some voting rights. They're probably going to want to have a say in when you refi or when you sell. It may be more demanding with some of the other deliverables on a monthly basis. That's a very different relationship than you go raise 2 million, from 20 investors who each invest 100K, and they don't have those certain provisions, voting rights, et cetera. It's, a true syndication versus a JV, right? So there's different ways of which you can raise capital and partner with investors that still provide you different levels of autonomy. So for me, I was very intentional about, I want to go and work with the latter, folks, right? A high number of people writing smaller checks so that I'm still a little bit more in control here. I did one deal where we brought in a large check writer who had, even just to say on capital events, when refinancing or selling, they had a voting share. And that just created problems, right? We had a misalignment in our interest there. I was the personal guarantor on the debt. I wanted to refi onto non-recourse. They wouldn't, we just basically ran into a problem there. So for me, it was a big learning lesson in that sense. Now, the other piece of this, the other big hurdle too, because these were the real big two when I started, was I hated asking people for money. I felt that asking people for money was them doing me a favor. It took me so long to get out of that headspace and to get into the headspace of, I'm actually providing a really great opportunity here in the form of I'm buying this insanely discounted deal where I'm going to be able to return your capital in 12 months. You're going to receive distributions moving forward, and we can 2x your money in 3 years, which was it's been most of the deals we've done have kind of returned at that level thus far in our business. And for me, it was I never liked the feeling of like calling somebody up and saying, hey, we got this deal. Are you interested in investing? So because I was so uncomfortable with the nature of that conversation, I just prolonged even raising money from these retail LPs that I wanted to raise money from, which is kind of the conversation you have to have. So again, tactically, what I did to get around that was I'm never going to ask anybody for money. So for me, I'm going to go build the platform and spend all of my time on bringing people to me. So I'm never asking for an investment. I'm going to bring everyone to me. I'm going to release an investment. If you're interested in investing, great. If not, I don't care. There's plenty of people on our list that do. And that kind of changed the psychology of that conversation versus the approach of, I have this deal. I'm going to go call these 20 guys on my list and pitch it to them on the phone. So it's funny hearing that I'm categorized by many around me as a sales guy because of what we do on the acquisition side. And that is sales, right? We're marketing and we're selling our, why we're good buyers to owners and all of that. But for me, it's like, I just don't need the constant rejection. I'm getting it plenty on the direct to seller side. I don't need it on the investor side as well, right? So for me, it was, I'm going to go and build the presence that allows people to find me and come to me versus me going out and finding other people. And I think that's what allowed us to really start to get off the ground and at least start to have those conversations initially.
Axel, that's exactly what I was going to ask you, because, I'm very similar to you when it comes to the capital raise, right? The reason we're both podcasters is for that same reason, right? It's much easier for me to create content and talk to folks in a public forum and just share what we do. And folks will raise their hand and say, hey, I'm interested in that, or can you share more with me? That's way easier than me calling somebody, asking if they want to invest, saying no, and me taking that rejection. With that said, I've always been more of a marketer, right? That's been my background. Did that for 15 years in the corporate world. But you come from the sales world, right? You come from being able to talk to an owner, build that relationship, figure out where they're at. So it's interesting hearing you talk about that dynamic, because I think our listeners, and I would even think that rejection is part of the process, right? And to your point, it's not that you're begging people for money. It's not that you're out there asking them if they want to invest, but you certainly have to present the opportunity in the same way that you do it on the acquisition side. So it's very curious and interesting to hear you talk about that and how you're able to accept rejection on the acquisition side, but not so much on the capital raising side. Can you maybe just take a moment to think about that and maybe elaborate about why you think it's more acceptable to take it on the acquisition side versus when it comes to capital raising?
I think it's interesting because on the surface, as you're saying, like there really shouldn't be that much of a difference. I think that when you get rejected, when you're trying to buy a deal from a seller, we know why we're getting rejected. Our number's too low. Like when we really cut to the chase, they want 5, we're at 4.25, and there's a gap there. It has nothing to do with us. It has nothing to do with who we are. It has nothing to do with anything other than seller wants X and we're typically at Y. The very rare case of maybe 5-10% of our offers that we're losing for some other reason, where it's like, maybe they had somebody else who actually did a better job at building that relationship with them than we did, who's been in their ear for longer, and we lost it because of relationships when the price wasn't the issue. Those sting a little bit more because it's like, okay, now we could have maybe done something a little bit better throughout this process that we didn't do, and that one we are a little bit more reflective on. But usually the 90% of the time, right, it's just price. I think on the other side, when you're pitching a deal to somebody who potentially is going to invest, the no's aren't as clear as to what the reasoning is. It can be because of the deal. It can be because they just didn't like you. It can be because, timing's not right for them. It can be because, they got burned on a multifamily deal a year ago from somebody else, and they might love your deal, but they're just a little stung from it. That's a lot of people right now too, who are out there investing passively. So it's typically more unclear what the no is. And I think it's easier to internalize the no when you're raising capital as you did something wrong or they don't like you, versus when you're speaking with a seller, it's typically just going to be a number and we are directly defining what the issue is. So, that's probably my sit on the therapist chair and analyze why it's a little more painful to get it from an investor. The other thing too that I just want to quickly mention as it relates to marketing versus selling too, because it's doesn't directly address the question you just asked, but I think there's some similar reasoning as to why that was a focus of ours when we started trying to raise money. Was it's far more scalable to build a marketing engine in any business, whether it's real estate or otherwise, versus trying to be the guy who's fishing with a harpoon. It's much easier to just throw the net out there, right? And that's true for the vast majority of businesses. And I think a quote that I really enjoy is, and I'm going to butcher it, I might not even get it right, I think it's a Naval Ravikant quote where he's like, those who can't build a product, those who can't build basically market. Like if you can't build a good product, you spend more of your time on marketing. And then those who can't market well end up selling. And it's like the best thing that you can do is have the best product, which in the world of real estate is offer kick-ass returns, right? So if you're trying to get your business off the ground, that's kind of the thing you got to figure out first. Next step down the rung is get good at marketing, because that's a much more scalable and easy way to bring folks into your business and to grow your business. And then you start layering on some sales, right? You typically don't want to start at the bottom and go the other way back up. And for us, that was something that kind of stuck out to me just as like a general business principle. So, it's like, we got to get the good deals. We got that figured out. Next is like, we got to, build a marketing engine, because that's long-term scalable. It's a better use of our, per unit of our time. And then now for me, it's like, now we've got such a long track record. I'm kind of, I've been in this for so long now that I'm outside of the fear of, it's a little less intimidating, going out there and pitching deals to folks. So if I'm at a meetup, I'm like, hey, you should passively invest in what we got going on. Here's a deal, and I'll share it and stuff like that. And now we can start to layer sales into what we do from an investor development standpoint.
Axel, I appreciate you sharing that, especially the psychology of, the rejection, because I think that's a fear a lot of people have, but don't talk about out loud, right? Like we talk about, I don't want to be responsible for somebody else's money, or, hey, I don't want to be out there just begging people for capital, whatever it is. But a lot of times it's that fear of rejection, and we internalize that rejection, and we put, our self-worth maybe tied to that rejection a little bit. Maybe it's me. Maybe I'm not as good as I thought. Maybe I don't know what I'm doing. Maybe, and these thoughts, these negative images, they just start creeping in your mind, and you could very quickly unravel your own mental state because someone said no. I remember the first time someone that I knew unsubscribed from my newsletter. Dude, it hurt me.
I had the same exact feeling when it happened to me. I know exactly where you're going.
And it seems stupid in hindsight, right? It's like
so dumb.
But in that moment, like, wow, this dude just straight up unsubscribed. Like, you don't like, I didn't ask you to do anything, man. All you had to do was just hit delete on the email. But you just said, nah, unsubscribe. I never want to get another email from this dude as long as I'm alive. And I just made this whole story in my head, right? Of why this guy unsubscribed, and maybe he thinks I'm an idiot, or maybe he thinks I'm going to fail, and all of this stuff, right? And as you grow, you realize it's like, no, the dude just didn't want the emails. Like, he's not interested in multifamily investing for whatever reason. I don't know, didn't ask, but it's not a fit for him, and that's okay. And the mindset shift here is stop trying to please everybody.
Yeah,
you've got to figure out who your audience is, because there's someone out there that is looking for the opportunity that you have to offer. And if we focus on the person who said no, we're never going to find them. The biggest companies in the world don't sell to every single body. There's someone who hates that company, I promise you, right? So your job is not to focus on the people who don't want the opportunity. I wouldn't even care why, right? Other than to learn. Maybe there is something that you could get feedback on. Maybe it's the presentation. Maybe it wasn't as polished. Maybe you didn't understand your market as well. Maybe it's timing, right? Whatever it is, certainly take that feedback, but don't equate it to your own self-worth or your view of yourself, right? It really just comes down to that person is not a fit. If there is something to learn, let's learn. But then let's go find the people who are looking for this opportunity. And I think that's the biggest change and the biggest hurdle for people who are starting off raising capital, because usually you're talking to friends and family, people you know. It's different when it's some stranger in Alaska that you've never met who is saying, no, I don't want to invest, right? But when it's the guy you sat next to for 5 years in a corporate office and you thought you guys were really good friends, or it's your friend from high school, or it's your wife's cousin, whatever it is, it just hits different, right? Because it's like, man, maybe this person doesn't think as highly of me as I thought, or you just start to fill in the gaps. And I think that's a big watch out everyone has to have. And just trust me. Listen, Axel and I both gone there. It's this fear that I think everyone has, whether they verbalize it or not. We do tie our self-worth into these things. The key, though, is to recognize it's not really about you. And you just get your ego out of it. No one really cares that much about you. I'm pretty confident when that guy hit unsubscribe, he didn't think 2 seconds about me. He was probably thinking, man, I got way too many emails. Jesus, I got 500 emails. Okay, just unsubscribe. I think he was just going through a list. I don't think he ever thought twice about me and what I was doing or anything like that. So let's just not overinflate our egos and think it's all about us. It's really about serving other people and helping them out, man.
Yeah, 100%. And I think a byproduct of embracing the marketing approach, marketing being content, or whether it's your email list, whether it's social media, whether it's a podcast, whatever it is that it's much easier to speak to the correct audience who is actually interested in what you want to do, because they're either A, going to find you, or B, you can define that in your messaging when you're actually putting it out there, right? When you post on LinkedIn, I'm assuming that most people's LinkedIn connections are people who have similar interests or in a similar corporate environment as to what they are, right? Just to use one example, versus I'm now calling up my uncle and my friend from high school and this person to actually go out there and raise money, where they even if it was the best deal of all time, they probably have no idea what you're talking about. right? You have to spend so much time educating them to put them in a headspace to where they have the confidence in their own understanding of what you're talking about for them to make a financial decision, which is an entirely different conversation, right? And then the other piece too, I think a lot of people struggle with this, at least that I see, in terms of starting to have these early conversations and raise money, because they haven't gotten that first part right above marketing, which is product service, right? Like, maybe your deal isn't good enough. Maybe you don't even understand what you're trying to raise money for well enough. Maybe you haven't done enough deals yourself to feel really confident in what you're even talking about when you go out there and raise money. Like, I didn't start raising money until I had done over 30 deals. You know what I mean? Like 30 2 to 6 unit deals, like flipped them, bought them, operated them, whatever. So for me, I'm like, yeah, it's just like, obviously this works. I've done it 30 times. Like, and you don't have to do it 30 times. You do it 5 times, right? If you do 5 deals with your own money before you go out and raise money, you're gonna have such a better sense of what the actual process is of getting that deal under contract, closed, operating it well, et cetera. So if you're feeling those, like, inadequacy, lack of confidence, et cetera, as you're having those conversations, you should try to have an honest assessment of like, do I even know the product that I'm selling, which is this deal, well enough to even get to the marketing or sales components of that ladder?
Axel, I love that, right? We always talk about the 3 C's of raising capital: confidence, credibility, and connections. And confidence is that first one. And that's what you're talking about. Confidence comes from preparation. You cannot fake it. We're not talking about blind hubris. We're not talking about fake it till you make it. Confidence comes from knowing your stuff. Like you said, you did 30 deals, right? Before you started to raise capital. So you knew your stuff. You knew how to do it. If you haven't done that many deals, maybe you're not confident in the process, take reps. Even if you haven't bought and closed and transacted, keep analyzing those deals, underwrite those deals, get a partner, get other folks on your team, a mentor, a coach, but build that confidence, credibility. What in your background makes you credible to deliver on what you say you're going to do. Again, surround yourself with the right team in this case if you don't have that experience yourself. And then connections. You got to be expanding your network. If you want to raise money, you want to do these deals, you have to constantly be connecting with new folks and expanding your network. So that's going to allow you to do that and to grow and scale. So I appreciate you breaking that down and just sharing more about some of the stuff you've seen in your business, but also some of the challenges other people face when it comes to raising capital for their deals. I want to go back, Axel, because you talked about the leads and that being really the lifeblood of any business, but really for your business and what allowed you to grow and scale. As you think about your approach starting out to your approach today, what changes have you made along the way that have allowed you to grow and scale?
Yeah, I think the underlying objectives have remained the same. It's been the volume and then the channels, right? So if we think about direct to seller acquisitions, right, it's early on, I was, literally buy a list, skip trace list, email owners, like one channel, right? Email. That's how we're trying to get deals.
Yep.
On the capital side, it's I got money in the bank and then I got these hard money lenders who are going to lend me, a bunch of money from an LTV standpoint. That's my channel over there on the capital side, right? I just have these lenders. I text them, I call them when we have a deal. So it's very simple, right? Now, fast forward almost 10 years, it's on the acquisition side, it's higher volume and then more channels, right? So a larger list with more outbound email, and then we add outbound calling, right? We, cold calling. And then we add direct mail. So now I'm sending mail, what used to be a couple times a year is now every quarter, right? 4 times a year. So it's once you get really good and sophisticated at one channel and you execute it extremely well, then you add another one, right? And I think the same thing goes for maybe your market focus. Crush it in this one market, build a nice portfolio with some scale, really saturate in terms of the deals you can do. And then maybe you add another market, right? I think that thought process has been pretty consistent with how we've grown the business. So it's max out one channel and then add another. And then on the capital side, right, it's obviously, debt's one piece of it, which is, we take it to debt brokers, but then we have all the equity side, which initially it was, I'm posting on Instagram. I'm going to put an Instagram post to try to meet these, potential LPs. I'm going to post before and after pictures of our renovations and talk about why, it makes sense to invest with us. And I'm posting once a week. Now it's higher volume of posting on Instagram, and we've gotten better at what we post there. But then we've added channels as we've kind of saturated one, right? Then it became the podcast. And for a while, it was just one podcast a week, every couple of weeks if I, missed one. Now it's like I try to get, one a week very consistently. Sometimes we do 2 a week where I do like a solo episode. So it's like same channel, higher volume. And then it's basically became the same thing with all of our other channels. I want to send the monthly email newsletter. That was when I started with email. Now it's email newsletter, but we send it 2-3 times a month, right? And I think I've gotten better at writing them. So for me, it's the functions are the same in the business. And I never want to half-ass a whole bunch of different channels, because then I think you get mediocre results and you actually don't even really know what's working well. No. So for me, it's saturate one channel, then expand to another, and try to build the infrastructure around me on the business side, whether it's people helping me do these different things, so that we are, really adequately giving each channel the attention that it deserves, so it serves the business and actually produces the leads we want.
I want to ask this question one of two ways, so I'll let you figure out how you want to answer it. All right. But let's start with capital raising side. You mentioned volume and channels, right? Figuring out the channel, doing it well, then expanding the volume that you have there. What channel has been the most effective for you? So I'll let you decide how you decide effective, but like you mentioned Instagram and email and others, but like what channel is the most effective?
I think the channel that's most effective, if we're going to define effective as producing good emails that go on our email list, that's what I'll define as kind of the what we get there.
We'll frame it as good leads, right? So
good leads.
The channel that's most effective as producing good investor leads
is the podcast. In terms of, we get the highest percentage of when I'm on a podcast and I say, I pitch aligned real estate partners. Hey, by the way, if you're a listener and you're looking to passively invest in the deals we do, et cetera, link in show notes. Whenever I actively push on the podcast, I think we developed a listener base that's sufficient enough to where that drives an email to our email list. And that email itself is an extremely high quality email or lead, because I have so much more developed trust with someone who's listening to a podcast and someone who's reading an email newsletter or a post on social media. The gap there is massive in terms of someone who listens to the podcast or any podcast really gets a sense of how the host thinks about things above and beyond just the content of what they're saying. You get a sense of their temperament, their attitude, how they think about problems, how they view, in our business, the real estate business, real estate investing, et cetera. Even if you're not talking about your business, even if you're not specifically talking about what, the deals you're doing and the actual results and in your business itself, just talking about real estate gives them a good sense of who you are. So I think that's the highest channel. I will say that as a little bonus, because I think, we don't get the highest number of leads from podcasts. It's just the best one. But the highest number of leads we get is every time I post on LinkedIn. Like as a specific social channel, I'm trying to become much more consistent and diligent about posting on LinkedIn. I think it's just much easier to get into the feed and head, in terms of people reading your content on LinkedIn, given that, we just understanding who's typically hanging out there as it relates to people that may want to passively invest or partner or what have you within your business, versus Facebook, Instagram, any of the other platforms. Instagram's nice. It's just like, it gives us a place to post pictures and all of that. But over the years, I've noticed I'm not really getting the best business out of that from an LP standpoint. I think, spent all the time growing it because it was a platform I was comfortable with when I started at the time 5-6 years ago in terms of posting. And I think Instagram is actually helpful in that it helps me meet a lot of other operators who we might be able to actually partner on deals with. Because I see, so-and-so's posting a before and after reno picture in this market, et cetera. And I found that it's good for that channel, but it's not necessarily good in terms of converting folks who are following what we're doing to LPs. Or I should say emails on our email list. So podcast one, and I'm spending a little bit more time on LinkedIn because I found that that's a pretty good source as well.
Same question on the deal side. So you mentioned you get a list and, you start marketing to them. One, and this is more tactile, I think, for folks who are looking to maybe begin some direct to owner marketing, which list source should we be looking at? Do you have a preference or one that, someone starting out should use? And then, if you could pick a channel to start with, is it the cold calling? Is it the email marketing? Is it direct mail? What's your guidance there?
Yeah, I think just from a data standpoint, list source is still going to be a great source for really anybody. We use Reonomy, which is a subscription-based platform, I kind of describe it as Walmart value brand CoStar. Still good. It's great. We can pull lists from that. We can look up ownership history, et cetera. But if you just want to buy a list source is good to go. Skip trace that with a lead Sherpa or, any of the million skip tracing services that exist. We just happen to use lead Sherpa. They've done a good job for us. Once you have property address, owner name. Ideally, you're getting behind the LLC and getting the either registered agent or a manager or member of that LLC. Some states it's easier to do that in others. New Hampshire discloses a lot of information in terms of who's behind LLCs. So if you're in a state like that, you should be able to get that information easily. Phone number, email, and then mailing address. Once you have that, if you're budget constrained and you don't have really any money to spend, or you have very minimal money to spend, you should start with cold calling, even though it sucks. You should just cold call. That's the highest and best, in terms of per unit of your time spent. If you spend an hour making 30 cold calls and you leave 25 voicemails, maybe you have 5 conversations, 4 of them tell you to buzz off. The other one's like, yeah, I'll have a conversation with you. I know it's some old guy who's got some time on his hands and is down to talk about his property. That's going to be how you have the most quality conversations, which is really the metric that we're trying to track. Is how do we have quality conversations with people? Put them on a follow-up list. They like us. They're open to hearing from us in the future. That's going to be the best approach there. If you have money to spend and you're a little bit more time constrained, direct mail is still a really good way to get in front of owners. You just have to have the patience to mail multiple times over a 12-month, 18-month period of time. When you do mail, the calls you get are going to be much, much higher quality conversations because they're calling you, right? It's when, you actually get a response from your marketing. That's going to be a much better lead, a much higher quality conversation. So for us, that's why we still, send the mail and do it, right? It's maybe we're, having less conversations as a result of sending this mail in terms, when comparing it to how many conversations do we have when we email an owner or call an owner. But those conversations are going to be higher quality with the people that receive the mail because they're a little bit more motivated to the sense that they're actually calling us.
Axel, great stuff there, man. You talked about List Source, Reonomy, doing a lead Sherpa or some other skip tracing tool. And then if you had to pick one, cold calling. It may take the most time. You got to sit there and dial. There's certainly ways around that and ways to be more efficient, but cold calling still works. Direct mail still works. So these strategies work. And again, going back to where we started the conversation, understand your market, understand your target, who are you talking to, put together a plan that makes sense and recognize the bottleneck. I really enjoyed our conversation for a few things. You talked about deals and capital, right? And from a deal standpoint, going direct to owner, creating your own lead source, that's going to allow you to always have control over the deals that you're going to see. On the flip side of that, when it comes to the capital, being open-minded, focus on marketing, not necessarily just sales, but the marketing that's going to allow you to reach a broader audience and have access to capital that allows you to grow and scale. For folks that do want to learn more and reach out to you, Axel, what's the best way for them to get in touch?
Yeah, absolutely. First of all, thanks for having me. And it was, pleasure chatting with you again. Email is going to be the easiest one. Axel, AXEL at aligned REP. So ALIGNED or alignedrep.com if you want to jump on our website, the Aligned Real Estate Partners website. The last thing I'll plug is Multifamily Wealth Podcast, talking multifamily once, twice a week. And great show for both operators and LPs, in my opinion.
I love it. Axel, always a pleasure to talk to you. Thanks again for coming on Multifamily Mastery right here on the Best Ever CRE show. We look forward to staying in touch, and I hope you have a great rest of your day, man. Take care.
Awesome. Thank you.